Good morning, everyone, and welcome to Allica Bank's second ever market briefing. And today, Katie and I, part of Allica Bank's relationship management team, are joined by our senior commercial underwriter, John Harrison. Before we get going and running through today's topic, John, would you mind giving us a little bit of background as to who you are, where you've come from, and what you do today? Is that okay?
Yeah, absolutely. Hi, Matt. Hi, Katie, and thank you for metaphorically sort of inviting me out of the office. Doesn't happen too often for us underwriters. But as you said, I'm senior underwriter here at Allica Bank. I've been in the bank for a little over a year and a half. It's changed massively. I've made loads of progress in that time. My role is I manage a team of underwriters that look after credit requests from the bank's relationship management team, predominantly in respect of our existing customers and new customer opportunities that have come to them via their introducer network and recommendations. I have been around the block a few times. I've got around 25 years in banking, most of which has been on the relationship, customer facing directly side. So I do find that helpful. I do find I can see both sides of the story. And the team's the same, actually. We've got over 100 years of banking experience within the team. A good mix of people and experiences. But what unites us is everybody is passionate about the Allica mission to give established SMEs the banking they deserve and help us to become the most recommended bank.
Lovely, thanks, John. I think it's really crucial, isn't it, that whilst you're necessarily behind the scenes today working with us as frontline colleagues to support more and more businesses, I think it's really crucial that you've been on the front line and done the job that we're doing and been the leader of RMs as well. It gives you that unique perspective. So if you wouldn't mind, let's jump straight into it. Obviously, in the UK over the last 3 or 4 years, we've been through a little bit of a tumultuous time with everything that's gone on. Would you mind giving a little bit of a, brief synopsis of those shocks, in inverted commas, and how you've seen credit applications change over that time period? Is that okay?
Yeah, absolutely. I mean, I think we could probably talk about that all day. So I know this needs to be a brief session, but I mean, certainly as far back as I can remember, working with SMEs, they have had turbulent times to deal with. I was, working with them in the heat of the global financial crisis. And just when you think you're kind of through that and got an even keel going forward, then Brexit happened, which was another big, shock and a lot of, fallout on the back of that. And then just when, it feels like it's stabilizing, obviously COVID happened, which had a massive impact on a lot of SMEs. We still see that now in a lot of cases. Just as we come out of the back of lockdowns, there's clearly, a very difficult economic, situation now in the country with the cost of living crisis, and obviously the war in Ukraine, which is, driving energy prices up, causing supply chain issues, which is obviously driving up inflation, which is then causing the Bank of England to need to increase interest rates to try and control that. And all of that feeds through to higher costs for businesses, and at times a lack of confidence. So, we do see some of that impact in applications. Clearly SMEs are a resilient bunch. In a lot of cases, we're still dealing with businesses that have traded through all of that. But obviously there are a lot of issues there impacting businesses that we have to look out for.
And I think one of the really crucial things, and Katie, I'm sure you see and talk to introducers and clients about this all the time, is just openness to those economic shocks. So, if there's something that's impacted a business, tell us about it. Tell us the journey and what you can do to mitigate it, right?
Yeah, I think definitely. I think, SMEs, it's just one thing after another over the last couple of years. And I definitely agree that, the openness piece is really key. And I think it's, as relationship managers, for you and I, Matt, on the front line, I think educating and working alongside clients and accountants and professionals around how things have changed around looking at applications before we even get to John. There's long gone are the days of where it's loan to value first. It's now debt service cover. So we have to, make sure that it is affordable debt to customers, and that's before we even get into credit. So that's definitely changed on its head. And then even after John, when it's been approved, we start to get over the valuation hurdle, which is a big key thing at the minute, and it's kind of like customers are having to do more and more homework and work to get to where they need to be. And it's our job, working with John, to educate everybody out on that front line in the SME world that works with SMEs to understand what we need to get them to where they want from A to B to C, to get that credit paper into credit, So yeah, definitely. The SME market has definitely gone through some turbulent changes.
I think you're absolutely right. And one of the things, I know there'll be a lot of, professional advisors, hopefully watching this.
Yeah.
But one of the things that really helps, given that we are still relatively, short time on the back of the pandemic issue, is up-to-date financial information. So we look at businesses, we our goal is to serve established SMEs. So a lot of the time we're looking at businesses where you can see a financial performance relatively stable in the sort of pre-COVID era. And typically what you then see is a lot of distortion through the sort of 2020 year end and 2021 year end accounts where, you have often things like revenues absolutely devastated by lockdowns. But then you have the impact of the government support, both in terms of grants and JRS money, and sometimes other initiatives depending on sectors. But that can often, distort quite badly a bottom line. So, one of the things that really helps us now, one of the things we're trying to understand, because we typically lend over, long term, up to 25 years, is how a business has recovered. And having access to good quality and up-to-date financial information can really help to tell that story, and often, be the difference between us being able to get a deal over the line at the level the customer wants, or having to be a little bit more cautious, because it's exactly as Katie said. The last thing we want to be doing is putting customers in a position where they are overstretched.
And I think one of the big things to say is every lender, not just, this briefing is not just about Allica Bank. It's about the lending market in general. And obviously every lender lends in a very different way. And we don't lend against forecasts, but having that foresight over what the next 12, 24 months is probably going to look like will only add confidence when talking to a lender as well, I would assume.
Yeah, definitely. I mean, it's often the way we've approached things, or lenders have approached things in the past, is to say, well, we'll look at your last filed accounts and maybe the year before. And if your last, and I think it's one of the biggest challenges for the market actually at the moment is how do we, lend on the back of the pandemic, and obviously it's probably not very helpful in the current climate to say, well, your last filed accounts were, included a lockdown and other restrictions and to base it on that. So that's where I think businesses that are on top of the numbers that can demonstrate how they're trading in the most up-to-date manner, then that will give us confidence. But also, again, and it sort of does go back to the global financial crisis, is the businesses that I worked with that did the best through that often were the ones that really got on top of their numbers, and those that didn't, I think, learned a very quick lesson as well. And it's sort of almost history repeating itself. Businesses that know exactly how they're doing week to week, month to month, they can use that information to make good strategic decisions. And it's a sign of a well-run business that says, I'm going to stop doing that because it's not making me money, or I'm going to start doing something else because it is, or use it to sort of control costs in other ways. So that's something which certainly advisors can really help their customers on as well by helping to push that message and helping to provide solutions.
That they're certainly key, aren't they? Sorry, Matt. The professional network out there at the minute supporting SMEs, the banks, solicitors, accountants. We are so key to supporting businesses with that information and helping them get there. It's in that SME space. It's we're really important. We definitely.
And I appreciate I said just a minute ago that this briefing is not just about Allica, but I think one of the big things that we're seeing is it's not a blanket industry policy, i.e. we're not turned off from the hospitality sector, which, has had lots of publicised challenges. We're still seeing good quality hospitality businesses coming to us, and more on that later on. But, we are still lending to hospitality businesses, John, aren't we? And there's still an appetite for the right quality of lender.
Yeah, one of the things that I would say, I think is frustrating for probably people on this call, it's certainly frustrated me in the past, and many other people I've worked with is, we know that some of the big banks will put blanket restrictions on sectors or transaction types. And, when you've got a really good quality business on your desk, but you can't progress it, that could be very frustrating. One of our USPs at Allica is, we don't do that. That we understand that there will be successful businesses, good business, good quality business owners, good quality business leaders in all sectors. And we can deal with the complexity to understand, which businesses we can find a way to support. So we don't apply those type of blanket restrictions. Hospitality is still a sector where, yes, it's very difficult for some. In fact, it's probably very difficult for most, given the rising energy costs and the rising sort of supply costs and staffing issues and everything else that's going on. But you still find winners. And still find, enterprising, successful entrepreneurs who can make a go of it. And we absolutely exist to back those people.
It's not one size fits all. It's, great.
If you both wouldn't mind, I'm just looking to sort of move the conversation on to a second topic, which I think is really important when talking to introducers and clients alike is, how do you and the underwriting team, John, assess a lending application? What are the key things? I mean, you've touched on good quality, the winners there. So what does that look like, and how do you assess that?
There's a lot we do go through. Katie already touched on it. The most important thing that we will look to understand when we are, trying to support a business is that they can afford the commitments that they're entering into. And again, financial information is key there. It's important to understand what their other commitments are, including other finance agreements. It's important to understand how the business is trading in a sort of up-to-date terms as possible. And we need to ensure that we've considered things like rising energy costs and what that might do to the business, things like rising interest rates, because they have gone up sharply over recent months. Hopefully bottoming out now, we think, but really just to understand how a business has coped with those shocks really that have impacted sort of businesses that were relatively stable. So ability to meet the commitments is the most important thing. We will then look at a number of other factors, such as the people running the business and their track record, the type of sector that the business is in, some of which are doing better than others. We will look at, how well secured the facility is, and what sort of assets sit behind it and are on the business balance sheet. But again, we will look at things like the track record of a business through tough times. I talked at the start about the various, things that SMEs have had to deal with over the last few years, and a business that has come through all of those cycles and unexpected shocks, really demonstrates a strong likelihood that it will continue to deal with the current situation. So, number of things, and kind of we like to understand the people as well. A bit about them, what their background is, their skill set is, their stability of their own personal financial situation. It tells us a lot about the need to draw from the business or the ability to be able to support the business. And also, what that asset base is and what other business interests they may have. I think that the one thing that, is true is, for advisors and for businesses is the more you tell us, the more we're able to help. Because
it comes back to that. It comes back to a story, doesn't it? It comes back to the story that sits behind the business. Business owners and accountants can tell the story, and the numbers should back that story up. And obviously, sadly, we don't do this off the cuff. We do a little bit of prep beforehand. And something, John, that you mentioned to us when we were doing our prep for this is, there's so many open source data systems out there. Just be open and honest with us if there's something that, is a little bit untoward or possibly challenging. Tell us about it.
100%. Again, I've heard businesses, maybe a good few years ago now say, they're advised not to tell the bank certain things. And as you say, I mean, we're a fintech. There is a lot of data available now. And, as a bank, we can access it. And if there has been a bump along the road, tell us about it. We often find a way to lend, where there has been a previous business failure or a previous repayment problem. Yes, if it's repeated or serious, or there's a conduct issue, then it's probably a different story. But where there have been bumps in the road, often that can be explained. And as I say, we will often find a way to lend where that has been the case.
Great. And, I appreciate we always love to finish on a high, but I guess this is I think it's a really useful question, something that we were explicitly asked, which was around, what are the insurmountable barriers, or what's the biggest reason as to why we decline credit applications, or what are you seeing at the moment?
I think it comes back to the first point, really. I mean, if we can't get comfortable that somebody is going to be able to service the debts, afford the repayments, then that tends to be the biggest reason why we decline. There are a few sectors for reputational reasons you wouldn't lend to, or if somebody's got a really poor track record of, adverse credit, something like that, then that can be a difficult thing. Or if something is very speculative, as you've already mentioned, we're not really a strong forecast lender. But the main thing for us, and the most important thing, is lending to people where we can be confident that the business can afford its repayments and can do that on a sort of sustained basis. And if we can't get comfortable with that, that tends to be where we struggle to lend. We try not to say no. We would try to say, this is what we could do, or this is how we could reshape it, or this is what you would need to achieve for us to get where you want us to be. So we'll try and find a positive, response, but accepting that we can't always do what people want us to do.
I think that's the beauty of having a relationship manager as well, is that, and I have to say the conversations that I have with credit where deals, it's quite a lot of the time it's not right now. So it might just be 6 months too soon for a business. So how then myself, Matt, and the other RMs go back and work with that business to then come back in 6 months. And I definitely agree with what I see is around the debt service cover. So I completely echo that. What we see on the front line is that affordability piece is first and foremost. We can lend 70%, loan to value till the cows come home. But if the business can only afford a loan at 55% loan to value, then that's where we're at. And I think speed is really key. That and where we are having to make these decisions, I think helps massively as well. So whilst it is ending on a bit of a negative about declining deals, it was the most popular question we got, Matt, weren't it, from out in the network? I think and I very rarely feel that it's a straight absolute no, unless there is CCJs or, adverse, that's the biggest thing that does make it a no. But it's not right now, or how do we, what can we offer? And we work absolutely superbly with credit to be able to go back and have those conversations of not right now, yes, or we need to tweak it in terms of the amount, or that open and honest dialogue with the client.
Well, thank you both for joining us today. I think there's some really key takeaways. The big thing for me is around openness and honesty, and telling us the story and look at what you can do to mitigate the challenges you faced over the last few years, if that's present in your financials. So, John, thank you very much for joining us, and I'm sure we'll see more credit applications come in yours and your team's way soon.
Hopefully so, and thanks for having me.
Thanks, John.
We've recently just posted an article online about the commercial mortgage application process. So our colleague Gareth Anderson has posted a really handy and useful guide around what that process looks like. And next time out, in the next 4 to 6 weeks, we'll be joined, Katie and I will be joined by Morgan Keating, who's our hospitality sector specialist. So we'll be having a little bit more of a deeper dive into the hotels and restaurants and leisure industry in the next podcast. So thank you very much for joining us, and see you all soon.